How inflation affects your money. An overview. Inflation is an economic concept that affects virtually everyone's finances, whether they realize it or not. It's the rate at which prices for goods and services increase over time, and it can have a significant impact on your investments. In this video, we'll look at how inflation can affect your money, what you should do to protect yourself, and some strategies you can use to make the most of your investments in a climate of rising prices. What is inflation? Inflation refers to the steady rise in the price of goods and services over time. In simpler terms, it means that your purchasing power is gradually decreasing as the cost of living goes up. When inflation is high, your money will buy fewer goods and services than it would have in the past. The primary measure of inflation is the Consumer Price Index, CPI, which tracks the prices of a basket of goods and services over time. When the CPI goes up, it means that the average cost of living has increased and prices are rising across the board. Inflation can be caused by a variety of factors, including increases in the cost of labor, raw materials, and energy. It can also be caused by factors such as government policies or changes in the global economy. While a certain amount of inflation is considered normal, high inflation can be harmful to the economy and can have a significant impact on your finances, especially when it comes to your investments. Understanding how inflation affects your investments is crucial to protecting your financial future. How long inflation can remain high? Inflation is a tricky subject that is hard to predict. The truth is that it can remain high for an extended period, making it challenging to maintain the value of your investments. The length of high inflation can be determined by a variety of factors, such as government policies, consumer spending, and global events. For instance, if the government prints too much money, it can lead to a surge in inflation that may last for a while. Similarly, global events, such as natural disasters or conflicts, can also contribute to inflation. They can disrupt the production and supply chain, causing an increase in the price of goods and services. Consumer spending habits can also lead to a prolonged period of high inflation. If people start to hoard money and stop spending, it can impact the economy and cause inflation to remain high for a more extended period. Overall, there is no definitive answer to how long inflation can remain high. It is a complex issue that requires a combination of factors to come together, leading to a spike in inflation. As an investor, it's essential to keep an eye on the economy, government policies, and global events that can impact inflation rates. By staying informed, you can take steps to protect your investments and mitigate the impact of high inflation. How does inflation affect my investments? Inflation can have a significant impact on your investments. Here are a few ways in which it can affect them. 1. Reduced purchasing power. Inflation can cause the value of money to decline, which means that the same amount of money will be able to purchase fewer goods and services. This means that your investment returns will have to exceed the inflation rate just to maintain your purchasing power. 2. Interest rates. Inflation can also impact interest rates. When inflation is high, central banks may increase interest rates to help control inflation. This can lead to lower returns on bonds, as bond prices fall when interest rates rise. 3. Equity markets. Inflation can also impact equity markets. Inflation can lead to rising input costs for companies, which can impact their profit margins. Additionally, higher inflation can lead to higher interest rates, which can lead to higher borrowing costs for companies. 4. Real assets. Certain real assets such as gold, real estate, and commodities tend to perform well during times of inflation. This is because the value of these assets tends to rise as the value of money declines. It is essential to keep inflation in mind when making investment decisions. A financial advisor can help you determine how much inflation you should account for in your investment plan. They may recommend investments that have historically performed well during times of inflation, such as commodities, real estate, or certain stocks. Overall, it is crucial to be aware of how inflation can impact your investments and take steps to protect yourself against its effects. By working with a financial advisor and making smart investment decisions, you can help safeguard your wealth against inflation's damaging effects. What can I do to protect myself against inflation? The impact of inflation on your investments can be concerning, but there are steps you can take to protect yourself. Here are some tips to consider. 1. Invest in assets that tend to rise with inflation. Some investments, such as stocks and real estate, have historically been able to withstand inflation better than others. By diversifying your portfolio to include these types of assets, you can better protect yourself against inflation. 2. Consider inflation-protected securities. Bonds that are indexed to inflation, known as Treasury inflation-protected securities, can help guard against inflation as their value is adjusted to keep pace with inflation rates. These bonds can be purchased through your broker or directly from the U.S. Treasury. 3. Maintain a diversified portfolio. A diverse portfolio can help cushion your investments against inflationary risks. By diversifying your investments across different sectors, asset classes, and geographic regions, you can reduce your exposure to inflation. 4. Invest in commodities. Commodities such as gold and silver can serve as a hedge against inflation, as they tend to increase in value when inflation rates are high. Keep in mind that investing in commodities can be riskier and more volatile than other investments. 5. Monitor inflation rates. It's important to stay up to date on inflation rates and how they may impact your investments. Keeping an eye on the Consumer Price Index, CPI, and other inflation indicators can help you make informed decisions about your investments. By taking these steps, you can help protect your investments from the negative impact of inflation. Remember, investing always involves risk, and there are no guarantees. However, with careful planning and a diverse portfolio, you can mitigate some of the risks associated with inflation. What do you think of our video? Let me know in the comment section below. If you enjoyed this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.